Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, August 15th, 5:08 p.m. Eastern Time, coming to you from stormy St. Augustine Beach, Florida, where the weather matches the markets with tonight's Revere Market Insight video. State of the market has been downgraded from weak uptrend to pullback with short-term caution. The short-term caution isn't news to anybody, but we've now seen indexes continue to deteriorate. And today was particularly a disappointment after the setup for higher prices was there going into yesterday's open. We got it, but we got absolutely no follow through. In fact, the uptrend was undone. Yesterday's uptrend completely undone by today's action. Check the trend gauge over here. Leaders downtrend, they're pretty much stalled, although they actually acted a bit better than the overall indexes today. In fact, none of the 21 over 21 leaders list broke the 21 today. We got a couple sitting right above it, but minor outperformance there. And also, I've got my universe list of about another 50 stocks. Only 3 or 4 broke below the 21 there. So but the leadership is stalled. It's not making any progress. We don't want to dive into the market and get chopped up, cut up, diced up, sliced up. And this big red arrow tells me to observe what's actually going on and heed the advice of the trend gauge. Short term got a little worse today. Uh, as the Dow joined the other 4 indexes with its first close below the 21-day moving average, another close below, and this arrow will shift to red. Medium term got worse also. S&P, mid caps, small caps all broke their 50-day moving average. The lone holdout there still the Dow. This arrow with another close below, and if the Dow closes below, we'll head towards neutral. Long term, we're still above the 200-day moving average, and a healthy amount above the 200-day moving average. That's a double-edged sword, as that is a major support area. Will it act as a magnet? Well, before we get there, we have to break through the 100 and the 150-day moving averages, and those tend to put up a fight in the indexes before they're broken. We'll have to see how that plays out. But what happened today? Bears clearly taking control of the index is very disappointing action today. As I said, after yesterday's setup was there for strength, but there was no strength, and a bunch of headlines during the day and overnight in particular, really weak data out of China that immediately hit oil, hit commodities, hit the indexes. We had a gap down middle of the night, no strength by the open, or actually there was some strength coming into the open as rates also spiked. Along with that China news, rates started to pull back into the open. The indices came off their lows of the day, but that was just about the high of the day, and that's never good news. We always write down the opening 30-minute and 60-minute range. You probably would have noticed that. It's there every day in the tail of the tape, and that sets the tone for the overall market. That opening 30-minute range and 60-minute range, there's a high percentage. It's over half the time you spend the entire time. You close within that opening 30-minute range. And if we're below it, that means bears are in charge. You get back above it, bulls are in charge. Setting the high early clearly means uh, that bears were in charge. And we did add one position, but we did more selling than we did buying and reduced our overall beta today. Here's the overall damage. The RG8R8 growth ETF composite. The strength shown yesterday completely undone. The stochastic one-day hookup undone. They're now down and all showing oversold and pointing lower. That was down 1.17%. S&P 500 at the open was down 0.35, trickled lower, based, closed lower, afternoon selling, down 1.16%. NASDAQ 100 down 1.06. Dow down a little more than 1%. breaking the 21-day moving average. Mid caps down 1.35, breaking the 50-day moving average. Russell down 1.29, breaking the 50-day moving average. Global 60/40 stock and bond down 0.81%. In-house GROTECTION down 1.19%. And let's dive into the charts and the tail of the tape, and we'll start off. Well, that's something we ended up selling today. But here's the S&P 500. So yesterday you could see that little stochastic hookup from oversold. Very often that's the beginning of an uptrend. No guarantee. However, it's looking more like this right now. This period back in December, and we trended lower below for an additional 3 weeks before taking off higher. Back here, it didn't fail. We went up for about a week and then had another bottom before taking off. But so we're oversold. That's not a reason to start buying. Anybody that did heavy buying yesterday found that out. We got stopped out on our U Pro that we took off the 50-day moving average, and breaking the 50-day moving average, we sold that for our max loss 0.2% of the overall portfolio. Any buys that we do, we size them so that when we're stopped, we don't want that first buy to lose more than 0.2% of the overall portfolio. So that's where we hit today. That was a 6.5% position. We ended up down 3% on it by the time we got stopped with the close below the 50-day moving average. So 0.2%. It's a paper cut. We don't want to get a lot of these paper cuts. The market has pulled back just below 4%, about 3.8%. Our portfolios are down about 4.5%, a little more than 4.5%. This is a normal pullback from a percentage standpoint, but we have these different levels that we pay attention to. And breaking the 50-day moving average shifts our adjusted portfolio beta from a floor target of 1.0 to a ceiling of 1.0. So until we start seeing some improvement in getting back above the 50-day moving average, and again, this could be just the opposite of what we saw yesterday. This could be one day of weakness below and pop right back above it. The bulls would like to see that. Like I said, we are extremely oversold. But until we actually get that trigger, I mentioned yesterday, we need follow through to the strength that we saw. The setup is there, but we need follow through. That's not what we got. So we'd take a step back. And the reason for that is it's a long way down to the 200-day moving average, another 7.7%. We won't lose that much because of these intermediate circuit breakers that will kick in on the portfolio as we hit different levels on the way down. Our downside is probably about 3% lower by the time we would get to the 200-day moving average, maybe 3.5%. So there's the S&P 500. Here's the NASDAQ 100. Again, failed stochastic crossover, ran into the 50-day moving average and reversed. So one closed barely above the 50, back below it. So below it now, 2 of the last 3 sessions, 3 of the last 5 sessions, and one basically right on it. Not showing, it did show minor relative strength yesterday and today, meaning it didn't make a lower low than last Friday, the way the S&P did. So you do see a little hookup in the relative strength line there. Dow Jones Industrial Average, breaking the 21-day moving average, the last holdout. Hooking back down, failed stochastic cross, also not quite to the oversold territory yet. Mid caps, you don't want to hear me make that sound again, but we did close below the 50-day moving average for the first time. Look at the S&P. When's the last time we were below the 50-day? Was the day before the 329 follow through day, 329 all the way back here. We spent every day above the 50-day moving average, going back to the March 29th follow-through day. The good news is we closed that day around at 40.28. We're now at 44.37, so about 10% higher before the stops start kicking in. That means we're locking in the profits that we made here as we get to a higher level before we start deteriorating below these moving averages that we needed to get above at much lower levels. These are signposts for the market and the market's overall health. Some people think it's voodoo. We know from our long-term performance versus a typical pie chart that it's not. It provides you a very clear benefit. And anybody that wants to get an explanation on that can certainly contact our office or continue to watch these videos. So here's the IWM. Uh, Undercut reclaim the 50-day yesterday, clear close below it today, oversold. Uh, Back inside this pivot now. So basically 5% up from the pivot, gave it all back. Let's flip to the VIX. We had a big spike up on the VIX today. That is not correct. It's not 2.49%. I've contacted IBD about this. They're having a bug. It's actually up 11% on the day. The VIX back above the 21-day moving average, which is very much not a good sign. We want to end back above that 15 level also. So it's reflecting the increased volatility on the indexes lately. You can see how much bigger those bars, those volatility bars are getting. Of course, ignore that one. It's going all the way down to zero. The dollar started out weak today, got stronger as the day went along, closed at the top of the range, not above yesterday, but still up and trending higher and at the top of this range, 2870-ish, three highs there going back to March, and we're approaching there. And a strong dollar is not good for stocks. Let's, how did this treat precious metals? GLD first, down 1/3%, GDX down 2.5%. Making, man, you just got to get out of the way of these when they break their moving averages. Silver down 0.24%. Bitcoin down 0.6%, continuing to trade in a tight range. Let's flip the bonds. Bond lower low on the bond over the broad bond index, meaning overall higher prices. Here's BND down 0.2%, TLT down 0.6%. The 30-year, I mentioned that these spiked overnight. Pretty volatile during the day, up, but not as bad as they were. But even when it was pulling back during the day, it didn't help the indexes. So that's another sign that things are not all good and well. Higher close on the 10-year going all the way back to October of last year. Again, not a good sign. Is that everything? That is all the inter-asset correlation as I go to my checklist to make sure I didn't miss anything. So again, market state from week uptrend to pullback with short-term caution. Let me clarify things a little bit here. Let me show this expectations. We classify markets into 10 different categories. And right now, we're transitioning or have transitioned from this early bull market to bull market mild pullback. We're between this -3 and -4% right now. We get over -4%, that's more mild correction, and right on cue, that's going to take us below the 50-day moving average, where we will get more defensive. So this is, kind of an explanation: mild correction, pullback. That's where I get the terminology from. But you can see 1, 2, 3 types of bull markets: a bull market pullback, which we are right now, number 4; 3 types of corrections that get us to 7; 2 types of bear markets, and then bear market rally. This is off the bottom, which we saw multiple times last year. And this is the expectation for what our portfolio should be doing under these different scenarios. Where are we? Okay, the news. Retail sales exceeded expectation. That's good. That means no recession. But then Empire State Manufacturing was below expectation. So those two conflicted each other. Talked about the additional weak economic data out of China that really hit the markets overnight. And then Fed head Kashkari came out and said he thinks banks need to up the capital requirements, not just the bigger banks, but the smaller banks also. That really weighed on the KRE and financials all day long. So market was taking it from all sides today. Bottom line, we're in a 10-day downtrend. That's 10 days below the 80 EMA, 6 days below the 21 EMA, breaking support on the S&P, breaking another support resistance level on the NASDAQ, but not making the lower low, so minor relative strength there. Here was the action throughout the day where we broke down late afternoon and in the morning. Only thing positive today, Warren Buffett bought a bunch of home builders. That sparked the ITB, and then the dollar recovered from negative. So that and bond yields, not really things you want to see together. And normally you wouldn't see the home builders up with the yields up either. But Warren, Uncle Warren overrides that. 11 out of 11 sectors down, the worst being financials, basic materials and utilities and oils. KRE also hammered, and semiconductors. What changes did we make in-house? We did offensive selling on DRV to lock in. This was our real estate short. We just booked that profit today. Offensive selling on that. uh, Meaning it broke below the recent level and then started bouncing back. So we locked it in. It went higher by the end of the day. Defensive selling on NRGU and UPRO. Let's show NRGU. And this is a case of you'll only spend so much time above the ADMA. We already had one undercut and reclaim last week. We sold offensively at 490, closed the rest of it about 461, as it didn't look like we were going to reclaim that ADMA by the end of the day. So like 27.5% gain on that last piece of NRGU. UPRO defensive selling, obviously with the breakdown of the S&P 500, and NVDA, there is a 1.5 time on this. NVDL marches in lockstep with it. We took a small position on this today. We did for some newer clients when we broke the 50-day. We sold. And if we buy Nvidia back, then the wash sale rule will kick in. So we bought NVDL instead. It's just a different way of buying similar but not exact security. So bought that when we went back above the 50 and the 21-day today. That reversed. We're down very small on that. Stops in place on every one of the few positions that we have left. So what we have left is SSO, the 4% Amazon, which we're down about 2% on. NVIDIA, big gains on this from our earlier in the year buys. Bros, 2% Bros, which we're down about 3% on. VRT, which 1%, which we're down about 3% on. Let's look at two strong charts before we wrap things up. And let's bottom line today. The bears very clearly taking control of the indexes, and the leaders have stalled until we get bullish evidence to the contrary. We get more defensive. As I said, that 1.0 flips from being a target floor on the portfolio to a target ceiling to keep us out of trouble. And barring bullish evidence, and now you got to be concerned that any bullish evidence is just a sell to for institutions to unload at higher prices. So that's another reason why buying unbridled strength is rare and not advisable when you're in a market that's pulling back like this. So that's the bottom line. Bears taking control of the indexes. Leaders are stalled. I'm going to show two more charts, and then we're going to wrap it up. And the ON, well, another leader getting hit. So this got slammed on its last earnings report, down 10%. Worse today, down 14%. Broke below the 50-day. Take it back off of your leadership list. After hours, Kava is up 9%. So back above the 50 level and the 21-day moving average. We don't normally mess with IPOs because of a very good book that has been written by some O'Neill disciples that does a deep dive into IPOs and how institutions don't really dive in until they go through a due diligence phase, and it's a bit soon for that. But anyway, Kava back above the 50-day. Anything else we want to take a look at? Well, let's look at the charts of what we still own in-house. Here's Bros. Tried to break out today on big volume this morning above 34. We didn't add because of the weakness in the overall market. That decision was rewarded. You can see as soon as weakness kicked in on the market, Bros rolled over. In fact, broke this 33 level that had been acting as support. We've got our stop below 32 on this. VRT, this was actually up today, putting up a fight, one of the leading stocks. But this is just a basketball underwater. But if you don't let it go, and the market in this case is acting as the water, holding it down, these stocks just don't run in when there are market headwinds like this. Celsius, maybe the exception, but again, we're not going to dive into this. ELF, we have our eye on. These are all 2121 stocks, pulling back gently since this is like more what you see when the market is pulling back and you've got an earnings gap up, and that is that it's difficult for it to make progress. The old basketball underwater. Amazon, we bought that yesterday, down 2% today, sitting basically right on the ADMA, that breakout over 140. Very short-lived. And NVIDIA showing some strength after the weakness, getting back above the 50 and the 21, but reversing by the end of the day, still closing positive. NVDL was what we bought as the alternative to NVDA. And that's going to wrap it. So as always, remember, it's not how much you make in the markets, it's how much of that you can keep. We're working on the how much you can keep at this point with the deterioration of the indexes and the stalling of the leadership. And if you're interested in this approach, reach out to us, don@revereasset.com, or my partner, Dan Stewart. If you're interested in becoming a client, that's dan@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. And with that, we will wrap up the Revere Market Insight video for Tuesday, August 15th. This is Don Vandenbord with Revere Asset, telling it like it is. The news isn't always good, but we strive for it to be accurate. Thanks for listening and have a great day.